This is the only video you need to become a profitable trader, and in this video I will be revealing a lot of price action technique that the top 5% are using to scoop money daily from the market. This pure price action techniques will change your entire trading life forever, and if you want these strategies to work for you, do not skip any part of this video, because each part of this video is as important as every other part of the video. And you know how we do it here. Hit the like button for more free courses like this, and if you are new to Trading Tribe, subscribe and turn on the post notification for 100 pips. Now, let's get down to business. We will start with the engulfing momentum candlestick. This signal occurs when a large candle fully engulfs the body of the previous candles. It is basically a big candle that completely covers the smaller ones right before it. This is not just a regular occurrence. It is a sign, a clear indicator of a strong move in the market. This is what we call an engulfing pattern. The psychology behind this pattern is all about market sentiment and the sudden shift in the balance between buyers and sellers. Before an engulfing pattern occurs, there is usually a clear trend. This trend indicates a strong direction where the majority of market participants are either buying or selling, and at some point the market starts showing signs of exhaustion. For a bullish engulfing momentum bar, this might be at a support area or at a demand zone where buyers believe the price is attractive enough to start buying in large quantities. For a bearish engulfing candle, this could be at a resistance or at a supply zone where sellers feel the price has peaked and it's a good time to sell. The engulfing momentum candle represents a strong shift in traders' thought process. If it's bullish, buyers have overwhelmed the sellers, pushing the price up and covering the range of the previous two candles. This suggests that the demand has suddenly outstripped the supply, and in a bearish pattern, sellers have come in strong, indicating an excess of supply over demand. The immediate effect of an engulfing momentum bar is to signal a potential reversal. It shows a decisive change of market dynamics. For bullish signals, it could mean the end of a downtrend phase, with prices likely to rise. For bearish ones, it could suggest the end of an uptrend wave, with prices expected to fall. For the engulfing momentum pattern to be a reliable signal, it should ideally be accompanied by high trading volume. This volume is the evidence that a significant number of traders have participated in creating the candle, thereby validating the shift in market sentiment. And please always wait for the candle to close to confirm the signal. When prematurely reacting to what looks like an engulfing momentum pattern, it can lead to false signals if the candle does not close as such. The psychology of this signal revolves around the trader's perceptions of value and momentum. In a demand zone, seeing a bullish pattern might lead buyers to believe that the market is turning in their favor, hence they buy more, driving the prices up. In a supply zone, a bearish pattern might scare off buyers and encourage more selling, pushing the price down. The breakout buildup. A breakout buildup occurs when the price action compresses, indicating a balance or a struggle between supply and demand, before one side eventually takes over, leading to a breakout. The market structures itself around various phases, which includes accumulation and distribution. During the accumulation phase, you will often see smart money buying up the available supply without causing a significant price increase. And in reverse, the distribution phase occurs after the price has risen and smart money begin to sell their positions quietly and slowly. A breakout buildup typically forms during these phases. The price action during a buildup appears as a tight consolidation, where the price moves in a narrow range. This consolidation suggests that neither buyers nor sellers are in full control, but both are actively involved. During this phase, the volume often diminishes, which might seem counterintuitive. However, This decrease in volume is a key indicator of a breakout buildup. This is because it suggests that traders are waiting on the sidelines, watching closely for a sign to enter the market. In a breakout buildup, the price action doesn't make big jumps. Instead, it moves slowly, hugging close to a key price level, like resistance or support. This slow, tightening movement is often called coiling, and a coiled market holds a good potential for a significant price move. Traders are watching closely, but they're hesitant to commit fully, not until a clear signal appears. This decrease in volume and smaller price range is a sign of weakening momentum in the current trend. It's like the moment of silence before the storm. The real action happens when there's a breakout, a strong price move out of the coiling pattern. This breakout can happen in either direction, but it typically follows the prevailing trend or the pressure from the dominant market side before the build-up started. For example, if the build-up occurs near a resistance level after a strong uptrend, the breakout is likely to push upward, continuing the trend. However, not every build-up leads to a breakout. Sometimes, the price might just hover around the level and then drift away without any significant movement. That is why it is important to wait for the breakout before taking a trade. Confirmation could come in the form of a price action signal, closing well beyond the level, or an increase in trading volume that supports the direction of the breakout. Bull and bear traps. Bull and bear traps happen every day, on all markets and all time frames. They are essentially the false breakouts of major and minor levels, where the price quickly reverses. A bull trap occurs when traders are misled into thinking that a rising price will continue going up after breaking above a resistance level. However, the price reverses and drops instead. A bear trap happens when the price breaks below a support level, suggesting a further decline, but then it reverses and rises. In order to find these traps, you can start by looking for a breakout that lacks conviction. This might manifest as a price that moves beyond an obvious level, but with low volume. If the breakout volume is suspiciously low, this could be a trap. Next, observe the price action around these critical levels. In the case of a bull trap, you might see the price pushing through a resistance level, but then quickly pulling back and closing below it. This indicates that the buyers could not maintain their strength, and the sellers are taking control. For a bear trap, it is the opposite. The price might dip below a support level, only to rebound and close above it, showing that the sellers are losing their grip and buyers are stepping back in. Another technique is to analyze the market structure. False breakouts often occur in ranges or during periods when the market lacks a clear trend. If you notice that the price is breaking out of a range, but the overall market conditions are not supportive of a strong move, this could be a setup for a trap. It is also useful to track how often a specific level is tested. A genuine breakout might initially retreat back to the breakout point, but it usually won't penetrate back through it. If you see the price breaking a level and then retesting it multiple times, be at alert, as this could indicate that the breakout doesn't have enough strength and it might reverse, signaling a potential trap. Long wick engulfing candlestick. The long wick engulfing candlestick is my favorite price action strategy. This candlestick not only indicates a strong rejection of prices, but also signals potential momentum shift in the market direction. This candle typically shows a large body with a long wick that extends far beyond the body's edges. The engulfing part means that the body of this candle is larger than the body of the previous candle, completely overshadowing or engulfing it. This visual on your chart is your first clue about a significant shift in market sentiment. The long wick represents a point where supply surpasses demand, pushing the price back down, depending on the direction of the wick. Now, let's say the long wick is at the top of the candle. This suggests that as the price went up, it hit a level where sellers were waiting to take profits, or considered the price as too high. outweighing buyers. This results in the price being pushed back down sharply, leaving behind a long upper wick. The rejection indicated by the long wick is significant because it shows that a certain price level could not be sustained. Buyers tried to push the price up, but the overwhelming number of sellers at that level rejected this move. If the candle also engulfs the previous candle, it shows increasing selling momentum. Despite any buying pressure that might have been present initially, sellers took control and managed to push the close below the open of the previous candle, indicating strong supply. If the wick is at the bottom, it means sellers drove the price down, but buyers stepped in, finding the lower price attractive, thus pushing the price back up, showing rejection of lower prices. Buyers were not only able to overcome the selling pressure, indicated by the long upper wick, but were also strong enough to close the candle higher than the previous candle's body, indicating strong demand. This is a powerful price action signal. It provides a clear signal that the market sentiment might be changing direction. Look for these patterns at major resistance or support levels, because they can signal the end of a trend or the reversal of a price direction. A bullish long wick engulfing candle at a key support level might suggest a potential upward reversal, tempting buyers to enter the market, expecting future gains. When you see this candle on your chart at these areas, it is a good sign that you can enter the trade and then place a good risk management with it. They are very powerful and more powerful when combined with support and resistance. The strength of these signal patterns greatly depends on the market structure with which they are traded with, such as supply and demand, support and resistance, trend lines and smart money concepts. And for each of them, I have made a full trading course from scratch and placed those trading courses in this playlist, including their best entry and exit targets. We are the Trading Tribe, and it's a wrap for this video. See you in the next one.